When it comes to building wealth through real estate, should you stick with the status quo of residential or take the leap into commercial property for bigger returns? I'm Tim Graham and the Property Playbook starts now. In this episode, I'm joined by Ben Carrington, Director of Compound Property and a specialist in both residential and commercial investments. Ben helps his clients navigate the pros and cons of each asset class to design strategies that align with their financial goals. Ben, welcome to the program.
Thanks for having me, Tim.
That's all right. Well, why don't we start? Tell us a little bit about Compound Property.
Yeah, so we're an investment-focused buyers agency. The whole purpose is to help people build wealth through property, and we do that essentially trying to build property portfolios through residential and commercial property.
Oh, very good. So typically what I've seen is a lot of buyers agents focus on residential or commercial, and you do both.
Yeah, I think it's quite important to go through kind of a portfolio journey to be able to offer both because, at some point income will become important and commercial can be a good asset for some clients.
Yeah, I suppose typically in the past, it's been the mum and dad investor going into residential and it was almost like commercial was for, the people with a lot of money to begin with. Is that still the case now?
Look, I think it's definitely harder to get into, but it is probably more accessible than people think, especially with a bit of guidance.
Yep.
So yeah, it is not for everyone, and particularly not at the start, but long term, it's probably more accessible than people think.
Yeah, okay. And I suppose you'll be able to talk to us about some of the pros and cons of residential versus commercial. Why don't we start there?
Yeah, definitely. So I guess as far as kind of pros for commercial, cash flow is the number one, right? And the reason for that is that a commercial property is a net yield, right? Meaning that essentially the tenant pays all the outgoings. So we're targeting property, say a 6% net yield, where in residential you're aiming for a 4 to 5% gross yield. So once you take out your expenses, property management, maintenance, council rates, you're probably looking at about a 2% net.
Yeah, wow.
So it's about 3 times better the cash flow.
Yeah, that's great. And in terms of the way that you finance it, it's a little bit different to what you would get with residential? Yes,
absolutely. So that's both the kind of positive and a negative, actually. So negative being you do typically need a larger deposit, normally 30% to get started. Look, there are some banks that will do lower with a pay down, but if you work off 30%, it's the safest. But the positive of it is everyone knows in residential at some point you'll reach a borrowing cap and you'll be maxed out. Where in commercial you can actually keep buying. The way you can do that is through a lease stock loan. So essentially the bank will lend you the money based on the property itself if you can demonstrate that the lease will be able to cover the commitments of the debt.
Yeah, wow. And obviously being a high interest rate environment like we've had the last couple of years, that higher net yield is going to be important for a lot of investors, otherwise they're not able to move forward again.
Correct, and I think probably that's what's shunned the spotlight so heavily on commercial is that back in 2020, 2021, all residential property was like cash flow positive, a lot of them from day one. But as we're getting to a bit more of a normalised rate environment, then people need to seek a higher yield.
Yeah. Okay, so when it comes to, I suppose, the education around property investment in general, there's so much out there for residential. I can go and find out vacancy rates. I can sort of self-source a lot of this stuff. In the commercial space, it's a lot more difficult. I can't just go and say, SQM, what's the vacancy rate on this suburb for commercial? So where do you sort of identify all this research? Where do you get it from?
Correct. Well, I think I looked at the numbers the other day. I think it's 600,000 or so residential transactions a year, and there's only 11,000 commercial transactions.
Yeah, wow.
And within those 11,000, there's so many different types. You've got industrial, retail, service stations, specialty. There's so many different things. So to get accurate data is very difficult. So it does, in a way, come from knowing, right? And that's like on the ground, speaking to agents, tracking markets. That's how you can really start to learn kind of a market intimately.
Okay. Why don't we talk about, I suppose, risk? At the moment, when we talk about LVR, the bank's willing to give you up to 95% on a residential property. Commercial, as you say, you can get 70% in most lenders and maybe up to 80%. So does that tell you that there's a bit more risk in commercial property?
Oh, definitely. And that's how the banks do perceive it. It is a high risk. And it's not for everyone, right? So the biggest risk in commercial is vacancy. So there are ways that you can measure that and mitigate it. But if you think about a vacancy rate in, like a vacancy period in commercial, it's typically 3 to 6 months. Now, a bad property might be 12 months to 24 months, and we have seen that. I mean, I actually saw the other day a cinema was for sale, a vacant one. I think that's a bit of a tough one.
Yeah, thanks, Netflix.
yeah, I think that's a bit of a tough one. But if you think about a residential property, every, say, 18 months, give or take, you have 1 to 4 weeks of vacancy. But in a commercial lease, say the average lease is 5 years, you might have a 3 or 6 month vacancy at once. Right? So over time, it's actually quite similar, but it comes at once. And that's what investors need to be able to kind of weather the storm.
Yeah, right. So how do you sort of structure things to make sure that you can accommodate those larger vacancy periods?
Definitely. So it's all about understanding the client's kind of situation, and you need to go in with strong buffers.
Yeah.
Right now, the thing that we do to mitigate that is we only buy tenanted property. So we don't buy vacant. So we're not taking on that risk. We're buying a property where we can see how long it's got, typically minimum 18 months remaining.
Yeah, on the lease, yeah.
And every commercial lease will typically have a 6-month notice period too. So you do actually, once you buy tenanted, you've got time, but you need to make sure you're buying something that's versatile, right? Because if you're buying a space, like for example, we looked at recently at a car wash, or like I mentioned, a cinema, or something that can only be a certain tenant, that can increase the risk. So we're looking for more industrial warehouse spaces or retail that can be used by a mix of different businesses.
Okay. That was going to be my next question. Have you got a bit of a niche that you sort of like in the commercial space? Because it's very broad commercial. It can be anything from retail to industrial and so forth. Do you have a particular niche you enjoy?
Correct. I think for us lately, industrial is the darling of the market.
Yeah.
So yeah, it's very easy to understand, just being basically 4 walls and a roof. It's very versatile, and obviously with e-commerce, there's a big push into kind of these types of properties. So we have been buying a lot of those. Retail is second, and what we love at a higher price point, you know, 3 to 4 million plus, is the retail centres. So you can buy like a little neighbourhood shopping centre with the multiple, with multiple tenants to mitigate that risk as well.
Yeah, that's right. Okay, that's interesting. So at Hotspotting, we've always said, you know, when you're buying real estate, the location you're buying is going to do 80% of the heavy lifting. How much does that translate into commercial?
Look, I think it is true, but it's not, because we buy a lot of residential as well. And as you guys know more than anyone, being the kind of leaders in it, picking the right market is essential.
Yeah.
But commercial is a little bit different in that, yes, you do get uplift from the market, but if you buy a good property in a say well-located street in a small regional centre, for example, it's always going to be important, and it's always going to do well. So it's not so much as picking markets at the time. It's more about picking the right property within those markets.
Just thinking, as an investor, if I was coming to meet with a business like yours, if you go to somebody who specialises in residential, they've got one product to sell. You go to somebody commercial, one product to sell, and you offer both. What's the triage or the discovery meeting like working with compound property?
Well, yeah, it's really important for us that we can be people's property partner for their whole journey. So most clients come to us with a starting point and they've got an end point in mind. So the first thing that we do is work out what is that end point, and if it's a high income, then we can reverse engineer, typically starting with residential to build up your equity to get to that 30% deposit, and then transitioning into commercial when income becomes the focus. Okay.
Is that like the trade-off between capital growth and cash flow?
Yeah, so this is a bit of a common misconception in a way, and there is some truth to it. So it's a bit of a funny one. So I think residential is considered better for growth, right? And it is in that it's more predictable, right? But if you think about it, long term, all commercial properties, if they didn't grow, they'd be half the price of a house, right? When you think about it, they've all grown, but it's not as easy to kind of get a huge result quickly, right? It's a bit more long term, but then obviously you get the net yield on top of it. So it is a bit of a mix. Okay.
If we were to sort of paint a profile around a commercial investor versus a residential investor, I dare say somebody coming in and starting to invest for the first time may not be suitable for commercial. When is the right time to start opening up the conversation around commercial investments?
Yeah, definitely. So there's a few different points on that. So the first one is we often do suggest you start with residential. And the reason for that is you need to go through a few little problems. You know, you need to build up the battle wounds to be able to take on a larger asset. But there are some clients that come to us with a significant amount of capital. They might be nearing retirement, and income is the focus. So in that scenario, going into commercial first might actually be the best thing.
Yeah, right. And when you're thinking about the long-term plan, I'd imagine because of that net income and the net rental yield that you're getting, would I be right in saying that can help you get back into the market sooner?
Correct. So what it does a few things. Every property that you buy is actually cash flow positive. So it doesn't actually affect your lifestyle, and it allows you to keep saving and obviously keep buying. What it also does, typically a commercial property will pay itself off over a 10 to 12 year period, depending on the yield. So because you can get yields above 6, right? So if you think about you buying a property, letting it pay itself down, and in 10 to 12 years time, you have the full rental return as your income.
Yeah, right. What about self-managed super fund? Are you seeing much in the way of commercial property coming into self-managed super funds?
Yeah, so we do a lot of self-managed super fund purchases for clients. Not that many have the full balance yet to jump into commercial. So what we're finding is they're starting with residential, similar to outside of super, but with the capital gains reduction. Obviously speak to your accountant about that. It allows them to build up their kind of equity or capital to then transition into that down the track.
Yeah, right, okay. What about markets around the country that are sort of leading in the commercial space? You got any locations you could share with us today?
I mean, the hottest market in commercial really is probably Brisbane. Yeah, because yields are really tightening there. So, you know, a few years ago you could buy a property there 6-7%. Now they're coming right down to 5% with huge interest in them.
Yeah, right.
Perth the same. So similar to residential, yeah, it's really like kind of come through its boom as well. But where we're starting to target is more markets like Victoria, which are a little bit more kind of softer and potentially better value down there.
Yeah, right. Okay. Well, finally, Ben, if you were an investor sitting out there at the moment wondering whether to go residential or commercial, have you got any tips for them? How do they get started?
Look, I think it's something you need to consider. It's always good just to know what's out there. So it may not be for you, but at least explore it, especially if you've got like that capital, because there may be a better use. So yeah, or obviously speak to us. Yeah,
that's it. Well, you heard it here first, folks. Speak to Ben. Thanks so much for joining us today, Ben. We look forward to chatting again soon.
Appreciate it.
Folks, that's the play for today. This program's been brought to you by hotspotting.com.au. This is Ticker. We'll be right back.